Okay, in this video I'm going to go over moving averages. Moving averages are one of the only indicators that I use. I use three different moving averages. I'm going to go over each one. I'm going to show you how I use them and why they are useful. Before I begin, as always, if you are learning how to trade, please do subscribe to Decisive Trading. It's free and there are a lot more trading videos to come. Okay, so I'll start on the FTSE and then I will do a Forex pair. Start on the daily time frame. The first moving average that I use is the 200 moving average. Just a simple moving average. I'll make this one orange so you can see it nice and easy. Now I use this on the daily time frame. The reason I use the 200 simple moving average is because, quite simply, it's very widely used. If you read any trading literature, or even if you just watch Bloomberg News frequently, you will always hear them talking about the 200 moving average. This is used by large institutions, banks, pension funds, all sorts of people to determine whether a market is in an uptrend or a downtrend. It's very simple. On the daily time frame, if the market is above the moving average, it's considered to be in an uptrend. When it falls below, it's considered to be in a downtrend. It's really that simple. You can scroll back, you can see it works quite well. You can see, so the market's above the moving average here, breaks through a little bit and it sticks above it. What you can also see is quite often it will react off of the moving average. So it comes up, it finds the moving average, and then it falls away. It's very useful just to, when you turn on your chart, you open up the daily time frame and you can see, so I can see straight away that this is in a downtrend. It's useful, and once you've got it on your chart, it saves a lot of time, and it's also good because it's what a lot of professionals are looking at. The second moving average that I use is the 60 simple moving average. This is one that I've just found works really well. I've used it extensively in the past. This is more for a shorter term trend. So if I drop down onto the 5-minute time frame, which is where I trade most often, I will use this to see daily trends. So when I open up the chart today, let's have a look. So 8 AM is the open of the FTSE. So this is where I would start watching the chart. I would turn it on. All I would see is this. This would tell me that the FTSE is currently negative. It doesn't mean to say that the market's going to fall away. It did here, but it just gives me a general outlook. So if I've got trades planned, then I will consider the moving average. So right here, you can see the market opened at 8 o'clock. It fell straight through the 60 moving average, and then it continued to fall away. It came down here, found support, it broke through the 60 moving average, and then it continued on its way up. It's a very useful moving average for short-term trends. I don't use it for trade entries. I definitely don't use moving averages crossing as trade entries. You see these all the time. This is a tactic that's used. It might work, but it's not consistent enough for me. The only thing you need to be careful with the 60 moving average is on days like this, where it's ranging. So you can see it's popping up above, it's falling below, it's coming up, poking through, falling below. You've just got to be careful with that. You will, as you watch charts, you will become accustomed to how they move. You can see here, it's the majority of the time it is above the 60 moving average and it's uptrending. Very simple. The other moving average I use is, this is probably the one I use most often. It's the 8, let me just change it to blue. It's the 8 moving average, but it's not simple, it's exponential. Exponential just means it's giving more weight to recent closes when it's calculating itself. I use the exponential moving average for two things. First of all, if I'm in a move, so let's say I went short here, I follow the market down, and the exponential moving average lets me know that the trend is still in place. So it would allow me to follow this the whole way down and then I would only exit on this candle right here. Because it breaks through and closes through the moving average. You can see the move up here. It allows me to follow this move up. Because quite often when you're trading, if you see something like this, you start to worry. Your emotions become involved. You don't want to lose any of the profits that you've racked up. The moving average takes that out of it. Here you go, closes through here. So I would have just exited either on this candle or as it breaks the low of this candle. It's up to you. The other way I use the exponential moving average is, let's have a look. So if the market is in a trend, so I can just use this again. If the market is in a strong trend, so say it's came down here, and I'm looking to go long. Now, you can see there's a pin bar here. If this was support and resistance, perhaps some people entered on this candle. Well, they obviously did, because you can see it's a bullish pin bar. For me, I would have ignored it. Because this is such a strong downtrend, I'd be looking for my signal to come after the market has begun to break through. So you can see the market breaks through here. This gives me a hint that the trend is slowing down. It then comes back down. And if this was support and resistance, I don't know if it is. I've not marked this in for this video. It comes down. I'd be looking for a signal as the market comes down here, right here. This is an engulfing bar. I can enter after this, and I've already had the proof that the trend is slowing down, and then the market pushes away. It's very simple. 3 moving averages. They work very well. I'll just use Euro USD I've got open. I'm going to put these moving averages on the chart, and I'll just quickly put them on, and then I'll go through it again. So this one can be the 60 simple moving average. Then I'm going to put on the 200 moving average, which is also a simple moving average. Oops. And then I'll put on the exponential. Now, the exponential moving average can be used on all time frames. And the 60 as well, actually. I use the 60 on the hour time frame as well, quite a lot. So let's have a look. So we're on the daily, we're on the daily time frame. Straight away, what can you see? You can see the market is below the 200, and what's happening? We are downtrending. Let me just zoom out and see. Okay, so then here, the market breaks above the moving average, remains above the moving average, and it continues in an uptrend. Now, look what happens when it breaks through. This is when the trend ends and it becomes a downtrend. This is why it's a very powerful moving average. I wouldn't just enter an order if it broke through the moving average. I certainly wouldn't advise that, but it gives you an added area of confluence. And it's something to look at in the morning. Just gives you a quick overall view of the market. You can see it's still underneath this moving average. If we drop down to the 5-minute time frame. So this is the 60 moving average. So you can see it was downtrending here. Very powerful candle breaks through here, and then it's remained above. So this has been uptrending. Just a very nice way to get an overall view of the market. It's above here, it's uptrending. And this is what I was saying when you have to be careful. This is actually overnight. You can see it's 2 in the morning. This is the Asian session. But you can see it's chopping up above, down below, up above, down below. This is when you just ignore the moving average. For a downtrend here, the candle here breaks the exponential moving average. This gives you a hint that this move is either losing power or is coming to an end. And it does come to an end. See, it's moving up, moving up, moving up. Breaks through the exponential here, comes up, breaks through here, and this is when it starts to lose energy. Comes across, breaks through again here, and then it falls away. So these are the moving averages that I use. If you add them to your charts, you can have a play about with them. You can have a look and see if they are useful to you. I'll just go into the 1 hour time frame. I'll show you this works on the 1 hour time frame as well. So you can see the market's below the 60, it's moving down. The market starts to break above. It also breaks through the exponential. This gives you your clue that the market, the downward move is coming to an end. Comes down, you get, this is obviously a news release. You can see it's an enormous candle. Breaks through, moves up. If you add these into your support and resistance zones, so you've got your support and resistance zones, and if you're ever not sure about entry, you can use these as an added confluence. They can become one of your even your trading rules. So you could say, when the market is below the 60 simple moving average, you're only looking to go short. When it's above it, you're only looking to go long. You can build rules with these. They can be used to add to gain confidence. They are very useful. I use them every day. What I must stress though is I don't use them as entry signals. So you can see it crosses over here. A lot of people use moving averages crossing over as an entry signal. I would never use that. I would never also use the market just falling below a moving average as an entry signal, because this worked here. It's great. But when you find choppy action, it does not work, like here. So if you entered when it broke through here, or even if you wait till it broke through the 60, breaks through here, moves down, then it comes against you. And then it breaks through here, you get one candle, and then it falls against you. This is where it chops you out. So I hope that was helpful. If you have any questions, do just comment in the comment section below the video. And if you are learning how to trade again, do subscribe to Decisive Trading. It is free. I'm James Orr, and I hope you enjoy the rest of your week.